What's up, everyone? So welcome back. We are ready for our Fed speech. We've got the SEP, that's a summary of economic projections, coming out in about 18 minutes right now, in just under 18 minutes. So we're going to get that. And of course, at 2:30 p.m. Eastern is when we have Jerome Powell and the speech from the Federal Reserve. So if you guys can see me and hear me, if the audio and the video is working well, just give me a thumbs up. And we'll also do like an audio check just to make sure that everything is working well. So just want to make sure that we are good to go. So once again, welcome. We do have the NASDAQ here pushing through right now. It's been mostly a lot of a consolidation type of day. So far we've just been trading sideways. And right now it's pushing up over 62 basis points. We do have the S&P 500 up over 60 basis points and the Dow Jones also pushing higher, up over 45 basis points at the moment. Lots of individual stocks have been doing really well. We got Apple up over 0.5%. Nvidia is absolutely killing it. It's up over 3.2%. This right here has been our trade idea. And it's kind of making a new high of day, just hovering around 136, just under 136. I'm still watching 140s for Nvidia. We'll see if we actually do accelerate, once Jerome Powell starts talking, and of course depending on the SEP as well, if you do see some momentum to the upside for Nvidia. And along with other names here, AMD is up over almost 2%. Tesla also pretty much more or less flat, pushing up over 10 basis points. So Swapnil says, thank you, Caddy, to cover your late night. Yes, happy to, and very, very excited to pretty much get this through. Is everyone hearing an echo? Ravi says, are you guys hearing an echo right now? It should really not be any echo. We should be all set with the audio. Let me just double check here. Oh, is it? Yeah, there should really not be any echo. Just want to make sure that there's no problems with the audio there. Okay, perfect. Great. So yes, Chinese stocks have been selling off. We did talk about Chinese stocks earlier. We are seeing a pretty brutal sell-off in XPeng and Li Auto, and NIO is down over 8%, so just under $19. Alibaba is down almost 4% to $82. So we are seeing a pretty significant sell-off in many of the Chinese stocks here. But yeah, those are names definitely selling off quite a bit. But the U.S. markets are still holding up, at least for now. And this is where we are going to be paying attention to. So this is when that statement's going to be released in about 15 minutes. So the time can't go any faster right now. The 21st, again, we're going to get that statement and we're going to get the projection materials as well. So that's going to tell us a little bit more about what the Federal Reserve has penciled in when it comes to interest rate expectations. And as it stands right now, they have the interest rates at around 2.25% to as much as 2.5%. So this is their old statement. And immediately we're going to be looking at this line item over here. So this is from their previous statement from back in July. They mentioned in support of these goals, the committee decided to raise their target range for the federal funds rate to 2.25 percentage point to 2.5%. And if this number gets up to 3.25% and 3.5%, that means they did indeed raise rates by 1%. And if this number gets up to 3.25 percentage points, that means they raise rates by 75 basis points. So this is what we are going to be paying attention to right at 2 p.m. Eastern. And then, of course, we'll be taking a look at the balance sheet, sort of what their plans are. Of course, it's going to be pretty much the same, that they are planning to reduce their balance sheet by about $95 billion per month, which is going to be $60 billion is going to be U.S. Treasuries, and about $30 billion or $17.5 billion per month is going to be the mortgage-backed securities, which is going to increase to $35 billion, and already has as of September. So I think that's going to be pretty much in line with the previous estimate. But this is going to be the most important part here. Okay, perfect. Let's see here. So Sandeep says, okay, am I lagging? Sandeep says I was lagging a little bit. Yeah, seems to be working fine for now. I feel like the connection is great. It says excellent connection, so really should not be any issue with a lag, to be honest. Should be working well. Okay, perfect. No lag. And yeah, markets here. Just quick update here. So 4 out of the 5 times when Jerome Powell has spoken, the markets have rallied. The markets have been very green in 2022. with the exception of the Jackson Hole Economic Symposium, with the exception of the Senate meetings. But everything else, we have seen pretty strong moves in the markets when Jerome Powell has spoken. So we already have a poll going on, so make sure that you do vote if you haven't already. We have a poll pretty much asking, well, how is the markets going to react once Jerome Powell starts talking? Are we going to see a further rally, or are we going to see a further sell-off here? So let us know. 48% expecting the markets to push higher even further, and 39% expecting a bit of a sell-off here intraday. I've never really done this late of a live stream, so it's kind of interesting that we're doing it around 2 p.m. Eastern. So it's great. So welcome everyone. Hi from Sweden. So again, thank you so much for joining in. I really appreciate it. Yeah, pretty much a split in the poll. There's a lot of indecision at the moment. About an equal amount of people expecting the markets to be higher and lower. So how late is it for you? It's almost midnight. Well, when he starts talking, it'll be almost midnight, so it's almost 11:30 here. And yes, the volatility is also going to be a very important indicator for us. Right now, we're just kind of coming down 1.6%. We've been, watching this as well. So hello from Austria. So welcome, Marcus. Thanks for joining. Hi from Pennsylvania. So again, thanks for joining, everybody. I really appreciate it. And again, the volatility is a little bit subdued, hasn't really been pushing higher. We just had a struggle breaking out for the VIX above 28, 29 levels. So we are just coming down here once again. And Bitcoin and Ethereum also seeing some momentum. So Bitcoin's up over 3.2%. Ethereum also pushing up over 3.6%. So definitely seeing a lot of momentum for cryptos. A little bit more on the risk on side. We are seeing some momentum. And there we go, NVIDIA just cruising past 136 right now. So, I've mentioned this in our Discord. If you did take this trade idea from over the weekend when we talked about it, if you are a little bit uncertain about what the Fed is going to say, and if you do think that there's going to be some volatility or some uncertainty, there's nothing wrong with some locking in some profits here for this NVIDIA trade. But my targets are still going to be the low 140s, at least get up to 140s, like kind of fill this gap a little bit later this week, all the way up to highs of 140s, 145, 150s for NVIDIA. So perfect. Thank you guys for joining in from Toronto. We got Finland, we got Los Angeles, Hong Kong, we got Qatar. Perfect. We got Switzerland, Norway. Man, you guys are from all over the place. That's incredible. Again, shout out to all of you guys. Belgium, the UK, Canada. That's great. That's awesome. So yeah, different time zones for everybody, and this is why I love our community. It's like we're on the grind. We're on top of things here. We're getting together, market open during Jerome Powell's speech, market close, whatever the case may be. We're just, tuning in to kind of keep us up to date with what's going on. So awesome. Netherlands, Kuwait, Mexico, Cali. That's great. Sweden, Taiwan. That's awesome. So, all right. So we got less than 10 minutes left for the SEP to be released. So what we have, so I'm going to do an audio check right now. Even though it's not going to matter until 2:30, but I just want to get it done so that we're on the same page and we have it good. So what I'm going to do is I'm going to play my own clip. I'm going to play my own live stream from earlier today. So if you guys can hear that, just give me a thumbs up in the live chat and we should be all set with the audio for when the time comes when Jerome Powell starts talking. So I'm going to play this clip right here. I'm going to mute myself so you can hear this. Just give me a thumbs up. Here again, very, very strong support area for Bitcoin, right? So we've just been at around 18,000 to as much as 18,700. So we're getting a little bit of a bounce back higher to 19,000, and 20,000 is going to be that next resistance level to watch. So have a big cup of coffee with you for the live stream. Yeah, I mean, you guys can definitely have a cup of coffees or drinks, whatever you want. I'm definitely not going to have it late at night. Perfect. All right, thumbs up. All right, good. We are all set with the audio as well. Can hear, super clear, perfect. Great. All right, so this is it. I'm gonna look at some stocks here as well before the SEP comes out. So again, let me know if there's any companies you want me to take a look at. But Tesla here seems to be still fighting at that resistance at around 309, 310. So right now we are still at that level inside this red rectangle. It's going to be very important. The volume so far on the day has been, I would say, decent. It's not like super high because we're more than half into the day here, and then we're only like 27 million shares traded. So the volume is a little bit lower on the day because again, because of the uncertainty with the Fed and everything. So we'll see whether Tesla gets any volume to come in and we break out over 315 or not. Apple, same thing. The volume's a little bit lower. We've only had 41 million shares traded so far. If you close the day in about a few hours, it's only going to be 75 to 80 million, which is still going to be below its average 10-day volume. So yeah, so Apple's still green, up over 0.5%, but the volume's a little bit lower for many of these stocks right now. And Nvidia, AMD, so chip stocks are definitely seeing a bit of a bounce. So semis are very much green right now. So we are seeing AMD, we are seeing Lam Research on semiconductor, we got Nvidia, Applied Materials, all of them pushing higher quite a bit. So and Nvidia, of course, up over 3.4%, pushing up to 136.23. So definitely pushing higher quite a bit. Somebody says, Caddy, when they make you the Fed's chair, would we get your statements before releasing it to the public? Well, great question, Sandeep. I don't think that would be appropriate by law here. Are we going to watch CNBC or what feed? So we're just going to be playing it off of the Fed, Fed's official channel. So this is going to be the FOMC press conference, pretty much live from their own Federal Reserve's channel that I'm going to be playing. So they're going to be starting very, very soon here. They already are starting, but they're just playing some music in the background. So at 2:30 p.m. Eastern is when they're going to actually start. But in about 6 minutes, we're going to get the SEP. So the speech is important, but the SEP is going to give us more understanding on how much did we get in terms of a rate hike and what the SEP is going to be like, what the economic projections are going to be. And right now, this is about as close to as we can get. We're only 6 minutes away. And right now, the Fed funds futures are pretty priced in with 85 basis points. So if you get, not 85, 75 basis points, so 84% probability for us to see a 75 basis points. So if you get anything above 75, if you get 1%, then you better believe it that the markets are going to be a little bit more surprised if you get a 1%. So 84% probability with under 6 minutes left for 75 basis points, and we are going to reload this as soon as 2 p.m. hits to get that statement and the projection materials for the U.S. from the Fed. Yes, FOMC party. This is what it kind of feels like, right? Just waiting for the statement. And this is going to pretty much affect, global markets as well. It's going to affect a lot of interest rates. We're going to keep a close eye on the 10-year yield as well. It's going to be right over here. It's kind of recovered a little bit. So, we were as low as 3.518% intraday to that low. And, so far we have kind of recovered to pretty much break even on the day. So this is also going to be very important to see how the 10-year yield reacts to this statement. So what we have over here is the S&P 500. We've got the NASDAQ. We've got the 10-year yield. And I'll also put the dollar index, so DXY, over here. So we'll have all pretty much a broad overview of everything that we're watching. So Breeze says, I'm a little nervous. How long until Powell speaks? So Powell is going to speak at 2:30 p.m. Eastern, so in about 35 minutes. So 35 minutes is when he's going to be talking. Yes, it would surprise me. Let's see. So yeah, make sure that you drop a like as well. We are almost there, 4 minutes. And the yields are at 3.565. The short-term yields have obviously been pushing higher, but we're still, 1-year yield is obviously much higher at over 4%. Then we got the 2-year sitting at 3.989. Then we've got the 3-year, so 1, 2, 3. So yield curves are all inverted right now, so we're pretty much messed up from the bond market standpoint. And then the 3-month is very, very aggressively catching up to the 10-year, which is sitting at 3.567. The 10 and the 30 is also about to invert very soon here. It hasn't inverted in a very long time, so that's going to be the US 10Y minus the US 30Y. Actually, that's going to be the US 30Y minus the US 10Y. Yeah, so it's almost inverted. It's pretty much at 0.005%. So we're almost at an inversion for the 10 versus the 30 there. All right. Nasdaq seems to be climbing higher here. Up 72 basis points. Again, volatility just down 1.6. What does everybody think? 75, 50, or 1? Most people, I think, believe 75 is what's going to happen, right? So Danny says 75 points is priced in. Yeah, 75 is what's been priced in, I think, in my opinion as well. So anyway, what's the time for? The time is for when the statement is released. Statement is going to be released in just about a few minutes here. So again, this was the previous statement released at 2 p.m. Eastern, July 27th. And that's what we're going to be paying attention to when the September statement is released. So, okay. Oscar says 200. I love it. So, Over says 1, 75, 75, 75, 75. Oleg's a little bit more optimistic, 0.5. Chubby says minus 25. So, you mean that they're going to cut rates. That would be crazy. That would absolutely be crazy if they end up cutting rates. 50 with hawkish words. 50 would be interesting, right? 50, I mean, that would also be very surprising for the markets if you actually get 50. Let's see here. 200, Sandeep also 200 with Oscar. Fed surprises everyone with 1 or 1.25. Man, if that happens, then yeah, it would be crazy. Caddy has true global audience. Yes, that's true. I think we've got people from all the continents over here representing every part of the world. I love it. All right, 1 minute until we get that SEP and the statement release. The Nasdaq and the S&P are both pretty much up 60 to 70 basis points. We're going to switch over to the 5-minute chart here to get a better look at the intraday price action. And don't forget, we've got the dollar index over here, and we got the government bond, the 10-year yield, which is pushing higher a little bit, back over 3.57%. All right, here we go. Might be a little bit too early right now, 30 seconds. So final Fed Funds Futures prediction for today. Yeah, of course, now is the time when the website doesn't even load. All right, so we do have the Nasdaq pushing up. We have the S&P also moving higher a little bit. So it is 2 p.m. Let me just see if I can reload this. Nothing yet. Still nothing. All right. This is crazy. I'm still reloading it. There we go. All right. So statement first. Okay. So we get 3 to 3.25%. So that is, guys and girls, 75 basis points. That's exactly what the market was anticipating. That's what we got. So we're going to move over to the projection materials. We're going to come down. All right. So, okay. Interest rates are expecting 4.4% at the end of this year. Okay. So right now we're sitting at 3 and a 3.25%. For us to get up to 4.4%, that is another, wow, that is a rate hike of 1.2%, 1.2 to 1.25% in 2 more meetings. That means, wow, they're going to have to do 75, or they're going to have to do at least 1% in one of those meetings. Yeah, this is bad. This is not good. And the reason is because they penciled in 4.4% for 2022, right? They're pretty much getting a full 1 percentage point increase from 3.4%. So right now we're at 3 and 3.25. So for us to go from 3 and 3.25 to 4.4, that's a full 1.25 percentage point increase in 2 meetings in November and December. We don't have a meeting in October. So volatility just spiked here. Wow. We literally just went over 30 in a matter of minutes. It took us less than a few minutes for the VIX to climb over 11%. I think it's the guidance. It's not so much about the rate hike itself. 75 was penciled in. I think that was the market's prediction. And look at the 10-year yield. It just blew past 3.6%. It literally just blew past 3.6%, and the dollar index also up 1%, with the S&P now negative and the NASDAQ also now negative, with the volatility, of course, spiking above 30. This is the first time we're seeing the VIX above 30 since June. Again, just going back to this, so they are expecting, the GDP, they're expecting only 0.2% growth in 2022. Unemployment, they're expecting 3.8%. I think that's a little bit more soft. I would not have been surprised if that was at 4%. PCE inflation, they're expecting at 5.4%. And core PCE, they're expecting 4.5%. I think the big gut-wrenching number for the markets was this 4.4%. Because again, if you think about where we are with interest rates at 3 and a 3.25%, because that was what they raised by 75 basis points in 2 meetings for us to go from where we are right now to 4.4. That means they have to do 75 for both of the next 2 meetings, or one of them will be 1%. And then we will come down to 25. So it's either going to be 75 in November, December, or it's going to be 1 and 25 for November, December. So looking at the dot plot now, wow, such a wide range. So now we also have 2025 numbers, by the way. So do we have that over here? Yes. So we do have 2025 numbers. They are expecting the 2025 GDP, again, 1.8%. That's going to be pretty much in line with the long run goal that they have. Unemployment rate to be at 4.3%. So in 2025, a little bit elevated, especially starting next year. In 2023, they're expecting unemployment rate to be much higher. 4.4%. So again, as they become more and more restrictive, a lot of these things are going to have the lag effect. They're not going to happen immediately. More of this is going to be more painful in 2023 onwards. Inflation, they're expecting for it to come down to 2.8%, so pretty much drop by 50% from 2022 to 2023. And then core to come down from 4.5 to 3.1%. But the interest rates, the 4.4%, that was the big gut-wrenching number. And this right here is the dot plot, right? So this is the dot plot. In 2023, members are even expecting for interest rates to get up to 4.75%. So, that is majority of members expect in 2023 for interest rates to be above 4.5, closer to 5%, right? So that is a very aggressive Fed that we have over here. And look at the markets, just absolutely bloodbath here. Brutal sell-off. So, yeah, we got the NASDAQ down 79 basis points, 80 basis points, and still falling. We got the S&P down 72, 74 basis points. We got the dollar index pushing up 1%. And, of course, we got the volatility, up over 11% all of a sudden. Took us a few minutes to break past 30 levels for the VIX. So incredible momentum in the markets. How fun was that? Just looking at that live. And let's see if you can get that markets pricing in for Fed funds futures or not. We'll take a look at that. And then again, in about 25 minutes is when we have the Fed meeting to start the press conference. So we'll see what Jerome Powell has to say about this, because, with the 2022 penciled in at 4.4%, and then 2023 is at 4.6%, that means they're still going to be raising rates going into 2023. That is, that is a very aggressive policy from the Fed. So yeah, I think is the economic summaries, the summary of economic projections was the big driver for the markets, and we'll listen in on what Jerome Powell has to say, and how much pain are they willing to accept for the economy before they actually start looking at easing on interest rates. But the good thing is that we only got 75 basis points, but the bad thing is obviously that the Fed is very prepared to raise rates. In a way, I also think of it as a good thing. And the reason why that is because it's good that they're now preparing the markets that interest rates are going to be at 4.4% by the end of this year. If they get there great. That's what the market was anticipating. If they don't get there, that could actually end up being bullish for the markets later on in Q4. So right now what they've done is just prepare the markets that, look, right now we're at 3 to 3.25%. That was a 75 basis point increase. And we are going to get to over 4% by the end of this year, 4.4%. So that is a pretty aggressive Fed. But if you don't get there, that could end up being more bullish for the markets in Q4. But of course, if you get there, it'll be indifferent. In other words, we will pretty much be where the markets expect interest rates to be. So what does everybody think? What are your thoughts? And by the way, make sure that you drop a like. We've got almost 900 people watching. And again, Jerome Powell is going to be speaking in about 23 minutes. We'll start our counter once again. In about 3 minutes, we'll start the timer so that we're up to date. But let me know what everybody thinks about the policy guidance. It was not so much about the rate hike. I think 75 was pretty much expected, so no surprises there. But it was mostly about the guidance from the Fed, which was very interesting in terms of how much they're expecting things. The one thing that really kind of is really starting to be very interesting is the GDP. The change in real GDP, they're expecting a growth of only 0.2%. That is really, really low. That is a significant revision down from 1.7%. So they're absolutely not expecting any growth in GDP this year. I'm surprised they kept unemployment rates pretty unchanged because, well, they are increasing it in 2023, but I still do think that it's going to be much higher. With as aggressive as they are, 4.6% in 2023, I doubt unemployment rate's only going to be 4.4%. I think it's going to be much higher than that. I think it's going to be closer to 6%. If not more. Because again, if you think about where interest rates are going, this is the highest level since, can anybody guess? Pop quiz. Quick pop quiz. This 4.4% is the highest level since what time period in the past? The interest rates. Because this is, 2007. So it's 2007, 2008, right? So we're going back to 14 years worth of high for interest rates. So not talking about the inflation, but we're talking about interest rates. So interest rates are going back to the same level as where they were back in 2008. So not talking about inflation. Inflation, yes, it's going back to 1980s. We're dealing with 40-year high inflation, but interest rates are going back to the same levels as where they were back in 07, 08. So even in 2018, we only got tapped out at about 2.5%. So we can actually look that up. So let's just see federal funds rate. So you can just see here, Fred. All right, so the federal funds effective rate, after today, we're going to be sitting at well over 3%. So you'll notice that we're going back to the same level as 2007, 2008. So if I zoom in on this, this was the last time, 2008, 2007, pretty much, we were at 5%, right? And even in 2018, 2019, we got tapped out at 2.5% before the Fed had to cut rates back down to zero. So the increase this time around has been very fierce. It's been aggressive. It's been fast. And right now we're going to be sitting. Right now we're sitting here around this level. So right now we're sitting at this level over here, 3%, just around here. So this is where we are. And by the end of this year, they're expecting the interest rates to be around here, right? So we're going to get up to over here by the end of this year, which is going to be very much in line with where we were last time in 2008. So we're going up to a 14-year high, and we're going up to that level twice as fast in half as time, right? So it's a very, very aggressive policy there. So again, it's going to be interesting, what Jerome Powell has to say. I really, really hope the questions are good. The questions are, worth listening in, and the questions are actually, something that will trip up Jerome Powell so we can actually get some good insight. And really, really wish there's no softball questions that he can dodge or just answer in a few lines and just get it done with. I really hope there are some good questions about future for unemployment and potentially, different scenarios about recession and what happens when the economy really starts to slow down and goes down and unemployment starts going up, and how is the Fed going to position themselves then? So Marcus says the market is overvalued. It should be half the price it is now. I do think that the valuations definitely need to be readjusted and based on the earnings estimates. I wouldn't necessarily say that it needs to be cut in half because of just how strong the earnings power and the revenue potential is for a lot of these companies. But I do think that, yes, there has to be an earnings revision for these companies, just considering that there is going to be potentially slowdown in earnings growth. So Oscar says, don't get your hopes up. Yeah, no, I know. I think the Senate is where we really get a lot of interesting insight from Jerome Powell, but during these Q&A, during the FOMC meeting, it's just not really super interesting from a Q&A perspective because a lot of these questions are just like softball questions. Sakati, so is this the 4.4% is what upsets the market, right? From all of this was presented so far. Let's wait for JP to speech. Maybe he will give us some more info. Yes, I think the 4.4% is the main driver for the sell-off that we're seeing right now. Because again, if you do the math, if you think about it, right, we only have 2 more Fed meetings left. If right now we're at 3%, 3 to 3.25%, and we're going to get up to 4.4%, and if you do the math there, 2 meetings, 1.2%, that simply means the Fed is going to be very aggressive. And now, if you look at the probabilities, I don't know if this has been updated or not, the probabilities would very much change. Yeah, right now it's just not updated. It'll update, and as soon as it does, we're either going to be looking at 1% in November and another 25 basis points in December, or we're going to be looking at a 75 basis points in November and another 50 basis points in December. I think that's going to be more likely. I think we're going to see 75 and 50 in November and December to get us to our target of 4.4%. But it's mostly the revisions. I think it's mostly the revisions that we got. So, okay, this is where we are. Expecting 75. Okay, so exactly what I just mentioned. 75 basis points expected in November and then 50 basis points expected in December. So that's what the market's pricing in now. So we can only get 2 scenarios, either 1 and 25, or we get 75 and 50 for the next 2 meetings. So 75 and 50 is what we have from the Fed funds futures right now. And then another thing that kind of, I think, spooked the markets was the change in real GDP. So they're really, really expecting the GDP growth to slow down substantially. I think at the beginning of this year, so if you come back to our last March, just, April, May, June, July, so that's like 5 months ago. 5 months ago, they were expecting the GDP to grow at 2.8%. In fact, at the beginning of this year and end of last year, they were expecting the GDP to grow by 4%. Can you believe that? They were expecting the GDP for the US to grow by 4%, and that number was revised down about 10 months later to 0.2%. So, goes to show the visibility the Fed members have on the GDP expectations, the growth rates pretty much went from 4% growth to 0.2% in a matter of just about 10 months here, 0.2%. So a couple things that really just, were not great from the policy standpoint, was not great as in like they were too aggressive and very hawkish, was of course the interest rates and the GDP that is going to be starting to hurt a little bit. So, all right. Sandeep says, yes, we are getting down to all the stocks at Caddy's fair values. Yes, we are coming down to very, very attractive levels. So how is Tesla? So let's take a look at some individual stocks here. We're gonna look at the damage. So Nvidia, still up 1%, still about 133, but look at that sell-off. I mean, just incredible. Tesla here down almost 1%, coming down to $306. AMD down about 20, well, still up 23 basis points, but look at Apple. This is just incredible. I mean, it was doing really, really well. You can almost tell exactly when the SEP came out. And Apple here was down 2% in that 5-minute period. 5-minute candle dropped 2%. And right now just consolidating sideways, so down 1% on the day. And of course, all the indices are down. The dollar index is up. Volatility is up a lot. Actually, it's only at 1% now. So that's quite interesting. So the VIX got a big spike of 12%, and we're back down to under 28, 27, 28. So again, the VIX has been acting super weird. Hasn't really seen a follow through at all across the board. So still coming back down, only at 1.3%, so 27 levels right now. Ethereum pretty much gave up all of its gains. Bitcoin gave up all of its gains. Long wicks on the upside for both Bitcoin and Ethereum. So Jay, are you talking about me, or are you having a separate conversation in the chat? All right, let's see here. Yeah, stock sales start. Oleg is expecting a big green reversal to the upside, so that should be interesting. And yes, the dollar is making new highs. The volatility, I'm still looking at it. Yeah, it's still under 28 right now. The dollar index definitely making new highs. New 52-week high of 111.578. So definitely a very strong move. So looking at the SPY now, we are still, I would say, at support. You know, this is about as close to the buyers kind of stepping in right now at 380s. So I'm gonna keep a close eye here at 380s. We'll see if the the buyers step in after Jerome Powell starts talking, or if we continue to see more downside here for the SPY, and there's going to be a gap to fill in at the bottom down to 379, 370s. And of course, we've got the support down to 371. So that right there is going to be that next support level to watch for the SPY. And QQQ also coming down to an area of support at 285. So this entire sell-off, we pretty much, got rejected there, sold all the way down to 285. So this right here is going to be that same support from back in September 14, 15, 16th. And if you do see a more persistent weakness and more bigger sell-offs here, then the next support is going to be down to $280 per share for QQQs. So that is going to be that next level to watch. So Gabriel, do I still think that NVIDIA is going to break above 140? It's hard to say. Again, depends on what Jerome Powell says. But absolutely, I mean, the guidance was not what the market was looking for. It's very, very hawkish. And another 75 and 50 is what's been penciled in now for November and December. So it's difficult to say. I mean, it's kind of held up a lot better, still under 133, but depends on what Jerome Powell ends up saying, right? I mean, this could actually end up being a bullish sort of catalyst in Q4 because they're preparing the markets to be ready for another 75 and 50. But if the situation improves on the inflation front, they may not have to go as aggressive as what they've penciled in today. So that could end up being a very strong catalyst on the upside in Q4, but obviously it's not right now. So it's difficult to say. Right now it's still holding up that support at 130s, but you guys are all putting up crazy predictions. Steve, Bitcoin's below 10,000? No, it's not. Bitcoin's just over 19,000. VIX is glitched out. Are you guys actually having fun with that? Just making me reload these pages and see what's going on. What's wrong with this? VIX is glitched out. Yeah, more of the same. Howard says he's going to probably talk more of the same. We already know the script, but I'm more interested in the Q&A and what ends up, what does he actually ends up saying. So VIX is at 30.18. Is it really? Why is it showing this so weird? It's just... Kevin, is it really, or are you just having fun here? Is it really? I don't think it is. It's still moving right now. VXN. All right, let me see if I can find here. Oh, okay. So it still shows 30 on Google Finance. It still shows that it's up 11%. I don't know why TradingView is not updated yet. Yeah, that's weird. That is weird. Let me see if I can find it on Webull. But yeah, Google Finance does show VIX is over 30. So you see, there we go. Webull also has it at 27.24. So I don't know, different data at different places. But Webull also has the VIX at 27.24. So it's just pretty much come right back down. Very, very strange for the VIX level. Yeah, I would also argue that TradingView is the fastest. So I don't know why it's not. Why Google Finance is actually showing a different number here, maybe, possibly. But anyway, The market's still down, recovering a little bit. We got Jerome Powell's speech in about 9 minutes, so we'll see. I'll have the S&P 500 actually down below here then, and we'll quickly look at the 5-minute chart, and of course we'll put the dollar index over here. The bond yields did have a little bit of a spike, and now they're starting to roll over, and the markets also obviously did see a pretty significant sell-off, but it should be interesting, whether we get a rally intraday again or not, because we are seeing the VIX come down and we're seeing the bond yields come down, so quite interesting. Yeah, Yahoo and Google showing 30.18. Maybe they're not updated yet. It might be a little bit delayed for them because it's already come back down from those levels. Oleg says, of course we will be green. Like, of course we will be green. There's no questions about that, Caddy. I love the optimism Oleg has on our live streams. So, Vinay, what do you think? It is an opportunity to start averaging in or wait for even better prices? Well, it really depends on individual stocks. I think if you're looking at individual companies that are coming down to your buy targets, then I would really not, worry too much on the macros. Sure, they're going to play a role in the short-term, analysis and short-term direction of the markets, but long-term fundamentals is what's really going to matter. And if the company is strong, if the company is good, then I think long-term the story is pretty intact. So I would focus on the fundamentals of those companies that are coming down to better and better levels. I mean, Google, for example, is down 1%, almost at sub $100. In fact, the 52-week low now sits at about $100.11, right? So down 30% year to date, coming down to some very, very attractive levels. So if it comes down to close to $90, not going to pay attention to whether interest rates go up a few percentage point more than what the market's expected. I'm still going to be a buyer. So, Caddy, do you believe a Santa rally is coming this year? Really depends on how much interest rates go up. That's pretty much what it comes down to, because, like I said, this could actually end up being a bullish catalyst in Q4 if the Fed doesn't actually get up to 4.4%. If they basically do 50 or 25 over the next couple of meetings, even though market's expecting a lot more, then that could actually end up being a good positive catalyst for the markets. And a lot of it depends on inflation as well. But the real question, I feel like the real question, if I were able to ask just one question from Jerome Powell, that's all I really need, is just to be able to ask one question from Jerome Powell. And I mentioned this in our Discord as well. Like, all I want to know is how far are they willing to push moving forward? Like in the next 6 months. Like, it's going to be a scenario-based question. If in 6 months unemployment is over 6%, inflation is still elevated, what would you do then? Would you still raise rates? That's the question. Like, would you still keep pushing even if the US is in a recession? And I don't want him to like dodge the question and be like, oh, that's not our goal. That's not, we're hoping for a soft landing, or we're hoping for, we don't get to that scenario in the first place. No. What if we get there, Jerome? Give me an answer. What if we are there? Do you still raise rates, or do you start pivoting? So I think that will really tell us how serious the Fed is and how aggressive, because now it's going to start to become serious. It wasn't serious to go from 0 to 2.5%. I mean, that's pretty normal, right? I mean, we need to get to neutral rates. Now it's getting more restrictive. Now it's actually going to start hurting growth. It's not going to start hurting unemployment. So that's the real question I think that we need to address here, is that do they still keep pushing even if the US is in a severe recession? If we keep dropping on unemployment, keep pretty much dropping on job growth and earnings growth and whatnot. So Oscar says, no, not pivot talk. Yeah, so I think it will be. I think he'll just say that whatever it takes, because I think he will say that, there are bigger consequences to not controlling inflation than there are to recession. So I think they're going to be pretty straightforward about that, but I just want to know. So yeah, the Fed's serious manner is how the $30 trillion debt allows. That's another thing, right? So if they keep raising rates, that's going to burden the US even more when it comes to the interest payments. It's going to be a pretty big burden because the debt levels have ballooned over the years because of the fiscal deficit, and as interest rates keep going higher, well, then that's a higher interest payment. So why is everything selling off and the market has got exactly what they expected with the 75 basis point swap? No. So really it was the guidance. I think it was the guidance that really resulted in the markets to drop here. But we are seeing a bit of a recovery. So we are seeing the NASDAQ getting bought up here after being down, close to 1.5%. So now only down 42 basis points. And we've got the S&P also only down 40 basis points. So Jerome comes on board. Jerome Powell actually comes on board in under 3 minutes now. So we'll start playing the live stream, and then we'll also watch the markets together. T-3, yes. All right. It should get interesting here very soon to see how the markets react to what Jerome Powell has to say. Gonna be taking some notes, and we should be all set. And every time he has spoken, again, 4 out of 5 times, the markets have pushed higher. So it should be interesting to see whether the markets can do the same. Except for January. January was the only time the markets didn't rally higher on Jerome Powell's speech. But every time else, we have seen a pretty significant rally of 2 to 3%. Man, it is getting late. Way past my bedtime right now. VIX back above 27 right now. So yeah, I'll drink some water. As soon as he starts talking, I'm going to pretty much be quiet. I'll observe. I'll answer some of the questions in the live chat, and we are all set. Here we go, 50 seconds. And close this out. The surprising thing really was the bond yields. The bond yields pretty much got a big spike, and then they pretty much rolled right over. We pretty much went up to as much as 3.64, very, very strong momentum upwards, and then pretty much came right back down to a flat day. Gabriel says 1:30 a.m. here in Thailand. Man, you gotta respect, man. Hats off to you. 1:30 in the morning and just still watching the live stream here. That's incredible dedication there. All right, so we should be all set. Let's see. All right, so I'm gonna set this up here. Let me know the audio. I just want to make sure the audio is working well. So if it's too loud, it's too little, just let me know, and we will make sure.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term deflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate, The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you can see pausing? Is it linear that you keep raising rates, or is there, oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Rachel.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening, but you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward looking and the lags in your policy are forward looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. It's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability. And I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy is improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market. As you know, it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
Sure. So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you could pick, and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term. I think that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook, and ask ourselves whether our policy is in the right place as we go. Thank you very much.
All right, so markets pretty much rallying right when he started talking at 2:30. There was a lot to take in, a lot of questions. Obviously, some of them were more or less the same, but kind of reinstating his stance on aggressive monetary policies. Pretty much mentioned that restoring price stability is the most important aspect of just having a good functioning economy. But there was some discussion. I would say the markets pretty much rallied on some discussion of a potentially talks about pausing interest rates, right? There was a few times Jerome Powell mentioned that they are going to get rates up to 4.4%. At least that's what their goal is by the end of this year, and 4.6% by the end of next year, and then for them to keep it there. So I think that is what the markets kind of priced in a little bit. So this is just the starting of potentially those discussions of a potential pause or a pivot. We might hear about that, in future meetings as well. But the number one goal remains that they are going to be very restrictive when it comes to interest rates. There's a lot of notes that I need to summarize and kind of put a video out in more of a summary format. So I'll definitely do that. But the markets right now, NASDAQ up about 0.5%. We got the S&P up 30 basis points. There's a lot of volatility intraday. NVIDIA got up to as much as 140, pretty much got up to filling some of this gap and hitting that target. So very strong move on NVIDIA. And we also had, companies like Tesla here at 311 right now, got up to as much as almost 314. AMD's up over 2.5%. Apple also pushing up 0.5%. So looks like, there is some momentum intraday, but again, we still have 45 minutes till markets close. So it's going to be interesting where we end up on the day. So thank you so much for joining, everybody. I really appreciate it. This was, again, very, very interesting, very, exciting live stream. Thank you for joining, everyone. Make sure that you drop a like and, of course, subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down in the description below if you want to, of course, join and be a part of our money investing community. And, of course, get access to all the buy and sell alerts, the trade ideas, and the options alerts as well. Gabriel says, have a good night, old man. Really? You're gonna call me an old man? No, but I am. In my sleeping, I am. Definitely like to go to bed at like 9:30 or 10 p.m. at night. So again, thank you so much. Really appreciate it. I will post the market updates and a full summary video later today. So again, thank you so much. Hope you all have a great day, great evening, great night, wherever you guys are watching from. And happy investing, and I'll see you all in the next live stream. Take care.